Hi, good afternoon. My name is Sean van den Berg and I head up client education at BSG Online. Welcome to our webinar on technical analysis and equity derivatives. Our agenda for today is to discuss a technical market overview, what's happening on the market and are there any opportunities. We're going to touch on some fundamentals. Today we're looking at the macro and micro effects on the market. But most of today's presentation will be focusing on technical analysis and also equity derivatives. So we're going to talk about the basics of technical analysis, support and resistance, trend lines and chart patterns. Then we'll discuss the pros and cons of trading CFDs and single stock futures. And we also want to highlight some trading ideas, things we're looking at. But the main focus also to show you the stockbroker report that we put out every day. It's a tool that our clients can use to make more informed decisions and hopefully make money. So let's start off with a technical overview of the market. We're going to go from the top-down approach, see what's happening on international markets, and from there, how does it affect the local market. So our first slide we're looking at here is the S&P 500, which is the broad section of the American economy, the top 500 companies in the States. This is a weekly chart of the S&P 500 just to show you how the market has been performing, the recovery since the 2008 credit crunch. We're looking at, first of all, higher highs. So we're a bit of a bull market. Secondly, we can see that it's trading above the support trend line. Just bring up my little highlight here. This is a support trend line, so as long as the share price stays above the support trend line, supporting prices, the trend is up. We also can see it's hitting resistance, so it's a very important turning point we're seeing right now. Remember, moving averages, I've got a 50-week and a 200-week moving average highlighted here. Anything below a 200-week moving average, for example, is what we call a bear market, hence my little logo there. So anything below that will be bad news. You can see the crossover of the 50-week crossing above the 200-week moving average, highlighting a bull market. Anything above that, well, this is what we call the golden cross, anything above that is considered good news. So things are looking good for the American economy. Remember, this is the gearbox of the global economy. So if that's doing well and there's the economy is growing and the jobs being created, the sentiment is carried over to all the other markets and ultimately will benefit the JSE. Let's look at some commodities, and obviously it's important to have a view on commodities, especially the oil price. This is the Brent crude oil price, this is the daily chart, and it's important first of all to see that we're creating a bit of what they call a triangle, and we'll be discussing this in more detail a bit later. A triangle is usually what they call a continuation pattern. The market moves up and then goes through a sideways market, consolidates before moving up higher. So we're at a very important turning point right now with the oil price. Obviously speculation around economic growth or global growth. If this thing's picking up, we anticipate a breakout above that. But the main thing also with regarding the oil price is the implications for inflation. If oil price goes up, obviously transport costs go up and it's a knock-on effect for everything else. Prices go up. And inflation is public enemy number one. We'll talk a bit later when we come to the macros regarding inflation. So we can see we're trading just above those moving averages. We're calling it bullish still. So it's an important turning point, either breakup or breakdown. We anticipate more on the upside. Obviously, the implications also, if you're a Sasol shareholder, with a higher oil price, with a weaker rand, very clearly the Sasol share price should be going up. So that's the benefit to you as a Sasol shareholder. So it's important to have a view or to track what's happening with the oil price. Gold. Gold has been in a bit of a bearish trend. We're calling it bearish. It's just below those moving averages. It hasn't really crossed to confirm yet, but it's also trading in a very important down channel. We need to break up above that channel to confirm a bull trend. So gold has been acting like a currency. When the dollar is weaker, people move into gold bullion, safe haven. Also remember, people move into gold because of fears of inflation. But say the main thing at the moment is that the dollar is strong, so people move out of gold bullion and they've been buying into the dollar. So the dollar has been acting like a safe haven. Obviously, implication for South Africa, our mines are sorry, let's get it out of the way here. Our mines obviously are still a very big part of our economy, and if the gold price is going up, our mines are very, very profitable. You can see since August last year, this is the whole Marikana story. Obviously affected production, and you'll see on the next slide also with regarding platinum, how supply and demand, the supply side was affected, and obviously the platinum price and the gold price went up because the mines were closed. With regarding platinum, you can see that it's broken above resistance. It's grown above the resistance level here also. We're going back to retest these levels here. It's important to see that the platinum price is the first time for a long time that the platinum price is exceeding the price of gold. So that's quite interesting to note. Historically, it's always been higher than gold. So we're going back to those levels. We're calling this bullish at the moment. It's trading above those moving averages, and it's breaking above resistance. So there might be opportunities in the platinum mining sector compared to gold. Here's the rand. It's important, if you're looking at the gold and platinum shares, to have a view on the rand. You can see that the rand is trading above those moving averages. We're trading in a little up channel. The anticipation in the market is we're going back to retest our highs here at 9 rand. So, again, those implications for inflation. Obviously, high oil price. We have to import it at a high at the weaker rand. Obviously, that's implications for inflation or imported oil, imported inflation, and ultimately the effect on that is the interest rates on the market. And obviously, when interest rates go up, the market goes down. So that's a relationship like a seesaw. Let's jump it all down to the JSE All Share. This is looking at the whole market. Our market is one of the only markets in the world to really be making new highs, new record highs all the time. It's trading in a very narrow channel. So people say, yeah, the market's expensive compared to what? If you look at the PE ratios, we're around about 15. Historically, we've been expensive at 18. We've been cheap at about 9. Obviously, our market is skewed towards resource stocks, the rand hedge stocks. Most of the stocks on the top 40 are rand hedge stocks. Hence, the movement of the shares and the movement on the JSE All Share. But saying that, yes, we're making new record highs. You also understand that we're also trading at very, very high levels. We're overbought. So anytime soon we can anticipate some profit taking. The market's had a good run. There will be some profit taking, and obviously overbought levels highlights that for you. We anticipate a pullback soon. But at this point in time, we're still calling it bullish. So the sentiment's bullish. And let's break it down further and say, okay, where are the opportunities? So we can look at the JSE top 20 resource stocks. These are the Anglos, the Billetins, the Xaras, the Kumbas, etc. You see how this has been performing very similar to our gold and platinum stocks. Here in August last year, our resource stocks started moving because of supply constraints. We've broken above all these resistance levels. We are now basically testing new resistance levels. We are overbought. We anticipate maybe a bit of a pullback. It might pull back to our previous highs, which is also very close to our 50% Fibonacci retracement level. And this will just highlight maybe a possible entry point again. Those are not in the market right now. Maybe a pullback might be an offer opportunity to get in then. So watch your markets closely. When we look at the rest of the market, we can say, okay, the financial industrials. This is the top 30 financial industrial shares in the market. Obviously, our banks. But a lot of these shares, especially on the retailers, have caused the market to run like this. Hence the possible rising wedge. We'll be talking more about chart patterns a bit later. So we've moved out of this nice little channel. We've gone in a bit higher. Obviously, the higher the angle, what goes up like a rocket comes down like a stick. So it's important to watch the support level, support trend line very closely for a change in trend. Again, also, it's highlighting overbought territory, so anticipate again a pullback. So both markets, and as it ultimately filters through to the JSE All Share, our market is high, and we might anticipate a pullback, from these levels. So a quick summary on a technical overview. The general sentiment worldwide and on everything is bullish, but we also need to understand that we are overbought. There will be some profit taking soon, and just be aware of that. So watch your stops very closely, and maybe lock in some profits at these levels. Okay. So are there opportunities in these markets? Yes, always. There's always opportunities in the rising market or falling market. Depends are you investor or trader. We'll be talking about it a bit later. So let's talk about more of the fundamentals before moving on. So macro and micro effects on the market. The idea is to look at the big picture. There's four major factors we want to look at. First of all, GDP. Is the economy growing or is it contracting? So is the economy growing more than 4%? At this point in time, the government is anticipating around about 3% growth this year. Yet so where's the growth going to come from? Will it be in the mining sector? We saw last year, obviously, all the strikes affected production. Obviously, it will affected the contribution from the mining sector. At the moment, there's strikes happening in the Western Cape on the farms. That'll affect the agricultural side of the things. They have to say, okay, what about manufacturing and services? Where the opportunities lying? Obviously, the companies that are exporting might benefit with a weaker rand. So maybe look at the industrial shares that are exporters. What's more important is to look at, have a view on interest rates. We are at 30-year lows. The MPC Monetary Policy Committee meeting has a meeting every 2 months to decide about interest rates. Are they going to raise interest rates? Are they going to cut interest rates? The general consensus is they are keeping interest rates lower for longer. Okay. What they make a decision on, they look at inflation. That is their number one priority. They have this thing called inflation targeting between 3 and 6%. We are, however, at the top of that range, trading at 6%, and obviously with a weaker rand and oil price going up, it will affect our imports, especially of oil, but also obviously our food imports will be affected. And that's a lot of things that are out of Jean Marcus, the Reserve Bank governor's hands. She can't really control it. The only thing she can control is interest rates. But she's also got a job where she has to keep her foot on the pedal to create economic growth, but also to put her foot on the brake, on the accelerator and also on the brakes for inflation. So it's important to have a view on these things. Now, we've spoken about a weaker rand already. Makes our exports more competitive. That's why you must have some rand hedge shares in your portfolio to take advantage of that. So it's important to have a macro view on the market. Micro view is just basically chunking down to the consumer. What is the interaction between the individual buyers and sellers? And the sellers is obviously the retailers and those kind of things, other companies. So obviously it influences the choices that people make. If people think that things are too expensive, they'll go shop somewhere else. So obviously it comes down to supply and demand. And also a business can decide how much to produce of the product and how much to charge for it. Interesting to note in a newspaper article recently that Apple decided to cut back on production of the Apple 5 because obviously the take-up has not been as much as expected. So these are all the things that help you look at opportunities. So the idea is to have a view of a macro and micro view. And obviously that helps you determine the investment cycle and position yourself accordingly. Okay, let's talk about technical analysis and some of the basic tools that a person would use. Now, this might be the basics, but professional traders do use this all the time. And very simple, but very effective. So we're going to talk about support and resistance, and trend lines, and chart patterns. So first of all, when we start looking at the market, first question you always ask yourself, what kind of market are we in? Are we in a trending market? Are we trending up? Are we trending down? Or are we in a sideways market? So the idea here with the market is to ask yourself, market first of all, direction, and then secondly ask yourself what kind of cycle are we in. There are 3 cycles. We get a primary cycle, which is your primary bull market or primary cycle, and primary bear. Definition of a bull market is higher highs, okay, and higher lows. That's the definition of a bull market. Obviously, it lasts from a few months to a few years. The bear market also lasts from a few months to a few years. Obviously, the cycle is a bit shorter than compared to a bull market. But our definition of a bull market is lower highs, lower lows. Okay, that's our primary bull and our primary bear market. Within our primary markets, we have also what they call secondary markets. Secondary markets in the bull market, these here are called corrections. They last from a few months to a few years. Okay. In the bear market, these little movements against the against the primary trend are called rallies. They last, as I say, from a few weeks to a few months. And the third cycle you get is a minor trend. Today's close compared to last week's close, or today's close compared to yesterday's close. Your goal, even as a short-term trader, is to determine are we in a primary bull or primary bear market. A lot of people get caught on the wrong side of the market, when they're long, when they should be short, and vice versa. So that's just the first thing you're always looking at and ask yourself those kind of questions. Secondly, let's talk about support and resistance, some of the terminology that we use in technical analysis. Now we've got a chart going up and down. We have an area of resistance, or people will say that's a peak, and an area of support, where the people will refer to as a trough. Now the idea is that every single point on this graph is a buyer and a seller. Or someone's wrong, either the buyer or the seller. Someone up top here is buying and someone's selling, and vice versa. Hopefully it's not you, it's wrong, on the wrong side of the market. So the idea here, when the market's rising, there's more buyers and sellers pushing the price up. Remember, this is demand, so there's greed pushing the prices up. Okay? You get an area where more sellers come to the market, pushes the price down, and we get a situation where more buyers come to the market and we support or prop up prices. So when the price stops falling and starts reversing around, more buyers come to the market. The minute we move above our previous resistance or previous trough, previous peak, that gives us confirmation that the trend is going up or continuing up. And so it goes on. What's interesting to note, with a rising market, previous resistance will become support. So you can now start anticipating how far will the market pull back, how far will it retrace. You can measure that. That gives you a bit of an idea of a turning point. I call them turning points. And the market will bounce from that. Okay, so in the rising market, previous resistance becomes support. In a falling market, in a bear market, previous support will be resistance. How far will the market rally? So I can just look at the previous support and gives me an area where I anticipate a turning point. Okay, so remember, in the falling market, by the way, there's more sellers than buyers. Remember, the emotion behind this is more fear. People getting out, panic selling, taking profits, wherever the case might be. Okay. Let's move on to the very first technical tool that you can basically use. It's called trend lines. Very simple, very effective. The idea is to find a prominent low, project it to a second point, and ideally to a third point. And then extrapolate it. The more times it touches, the more times the share price touches that support trend line, the more reliable it is, number one. Number two, the longer it takes, the more reliable it is. So as long as the share price stays above that support trend line, the trend is up. And as a cliche in the market, the trend's your friend. So we watch it closely. When it starts coming back here and it breaks through our support trend line, we talk about triggering a change in trend, or trigger a sell point. Okay? So the idea there is that we close below our support trend line, we have confirmation, change in trend. The same here also with a falling market. We connect our highs together. The more times it touches, the more reliable the trend line is. The longer it takes, the more reliable it is. The idea is that we want to see a confirmation change in trend when we break up through that resistance trend line. So the idea is also that we close above that trend line. That gives us a change in trend. Remember, a third of the time the market's moving sideways. In the sideways market, this is where the buyers and sellers are having a bit of tug of war, where the supply and demand is in equilibrium. So this can happen, can go either two ways, either break up and continue up, or it can break down. So that's why we use trend lines as a trigger to help us get in and get out the market. Okay. When we talk about the charts just now, you'll see how these things all fit together. Let's talk about another tool that traders use. We talk about two groups of patterns, chart patterns. One group called reversal patterns, the other one called continuation patterns. The most common ones you'll find is what they call double tops and double bottoms. Obviously, double tops at the top of the market, reversal down. At the bottom of the market, change of trend of reversal up. I always think of McDonald's arches. It's like the big M's. I always think of McDonald's being bad for you in the sense that the minute it breaks below my support trend line, that gives me my trigger to sell or to go short. At the bottom of the market, I always think of Wimpy, double top and double bottoms. So it looks like a W and it looks like an M. So the minute we break up above our previous resistance, that gives me the trigger to get into the trade or to go long. The most common or the most useful reversal pattern to use is what they call head and shoulders. When I say useful in the sense that you can actually use it as a price projection. How far will the market go? So here we got, whoops, let me just go back to my place again. Here we got our left shoulder, there's our head, and there's our right shoulder. The idea now is to connect the two support levels or the two troughs together, what they call the neckline. And you'll only get into the trade when it breaks through that neckline. Now the price projection, the tool comes in handy when you measure the top of the market to that trend line, and that same distance you measure on the breakout. That gives you what we call a TP, or take profit price. Okay, gives you an area of a possible target to aim for. You've got about an 80% probability of being right, not too shabby. That's head and shoulders you find at the top of the market. The bottom of the market you find what they call a inverse head and shoulders. The same thing again. That's your left shoulder, your head, and your right shoulder. Again, you usual draw your neckline in. Doesn't matter if it's pointing up or down. What's important again is the breakout. By the way, we're looking at price charts. Remember the other factor we look at, we talk about technical analysis, is volume, the number of shares traded. So ideally, you want to see volumes increasing on the breakout. You want to see panic buying. That'll confirm the price action. Remember, on falling, when the market falls, you also want to see increased volume. You want to see panic selling. That gives you that confirmation. So these are just some of the chart patterns you'll be using. We spoke just now about the rising wedge and the falling wedge. This is what we anticipate might be happening on the financial industrial index. We anticipate a breakout. Usually when the breakout happens, it happens and it occurs very sharply. Okay, so you have to watch it very closely. Watch this breakout of the support trend line. So rising wedge at the top of the market, trend reversal down. A falling wedge at the bottom of the market, trend reversal up. You're not watching the market, you miss these opportunities. Raw information, this shows you where emotions have gone crazy. Excessive bullishness, excessive bearishness. Excessive bullishness, excessive bearishness. Excessive bullishness, panic selling. So when you start seeing that pattern happening and you see this broad information happening, either you trade it or you stay out the market. So let's look at some practical examples. This is the one we saw recently, and this is the reason why we put a trade on Mr. Price. We saw this double top happening. It didn't break up above our resistance, so we anticipated a pullback. Number one. Number two, we also anticipated, based on our oscillators, we saw they were overbought. So we used this little channel here, and that point there was our entry point. It broke below our support trend line. We anticipated really, we knew that's going to be a double top, trend reversal down, so we need direction. All we have to just get into the trade. Guys, Impala, this is the opposite now. Impala made the nice little W. Remember, W is our good old Wimpy. Wimpy, good for you. Trend reversal up. So you can see where the market went to. Okay. Again, we're at the bottom of the cycle, so it's highlighting where we were. The probability the market should turn direction, turn up. Okay. Let's move on. So the second group of chart patterns that people use, and this is more effective, is what they call continuation patterns. So the two most popular ones are what they call rectangle. We've been talking about it already. Area of consolidation. Remember, it can go both ways. It can either break up. If we came from the bottom, we move sideways, and if we break out of it, that will be a continuation pattern. If we came from the bottom and we move sideways and we broke down through our support trend line, that will be a complex triple top. So obviously a trend reversal. So the most popular ones, and this is the most useful one, is what they call triangles. The idea is that we have two converging trend lines, okay? Symmetrical trend lines, both the same, both trend lines are equal. The idea is that some rules involved must attach at least 5 times before breaking out. But also now the useful tool is you can measure that distance, and from the breakout, again, give me a possible take profit level. Okay. Okay. And we'll see some examples just now. Flat tops and flat bottoms are also very, very useful. You'll see example now, just now with Aspen, and how these things work, especially when it starts making new highs. New highs can make new highs. Here's a Standard Bank, and here's our little symmetrical triangle we're anticipating versus breakout. I said you can measure that distance. and you can see where the market goes. So let's say the odds in your favor, you know direction, you know the trend will be moving sideways or going up after moving sideways, but also you know where the market's going. Gives you a possible target price to aim for. Here is an example of a rectangle formation. This is on mass mart. For a while it was moving sideways. Measure that distance and the breakout, you can see where it goes. Nice thing also, you can draw a nice little channel, and that was our trigger also to go short. Okay, there we go. Oversold. But I just want to highlight is to say the sideways market, that's a minimum target. It exceeded it. Okay, so this is how you use your chart patterns as such. Talking about Aspen, there's a flat bottom or extending triangle scenario. We need to break out above our resistance trend line, measure that distance. Remember also, this is also making new highs. So ultimately, we meet that target. Okay, flat tops are very, very useful and very powerful chart patterns to look for. So that is very, very basic technical analysis. Just to give you an introduction to the tools that you will use. Obviously, there are other charts and other chart patterns you'd use, but those are the most common and most popular ones to use. So let's talk about trading CFDs and single stock futures. What is a CFD? It stands for contracts for difference, the difference between the price you bought it at and the price you sell it at. So first of all, it's a derivative. It derives its value from underlying share. So you still do your homework on the fundamentals and technicals based on the on Anglos and Billetons and Sasol. The main idea here with CFDs and these derivative products is the advantage is you can go long, take advantage of rising prices, but also take advantage of falling prices. So in the past, we couldn't really sell short or that you call bear selling. Now you can using derivatives. At PSG Online, we only trade on the top 100 companies. They are liquid, and obviously these are good quality companies that you're looking at. When it comes to CFDs, we ask for initial deposit or a margin of 15% for the top 40 stocks, and then we ask for a slightly bigger deposit on the mid-cap stocks. There are limitations with regards to CFDs. There's a minimum exposure requirement of 25,000 Rand. So you need to have at least 4,375 Rand margin to be able to open up a trade on CFDs. So the CFD is not for everyone. Just take it in consideration. There is a minimum exposure. So the main thing is that a lot of people understand, yes, we bring down an initial margin of 15%, but you must understand that that 15% gets ring-fenced. You always have to keep it at 15%. Compared to equities, remember, you might have a paper profit after 3 months of 30 or of say 10% returns on your money, which is not too shabby in 3 months. The problem is that is a paper profit. Only when you sell the shares will that money be in your account. Now, I'm not saying about derivatives, we have a thing called market to market. On a daily basis, that profit or loss will be in your account. So the idea, if you bought something at 10 Rand, it goes up to 1 Rand, up to 11 Rand, you're making it 1 Rand. That 1 Rand profit in your account tonight. However, if the market goes against you, you need to top up. And this is where this variation margin comes in. Whatever that movement was, now example 1 Rand, you need to top up. You need to, you'll have what they call a margin call. You need to deposit that 1 Rand into your account tomorrow. Okay. So if it drops 1%, whatever your 1% of your exposure is, you need to add those funds into your account tomorrow. Or we close out your position to manage the risk. Okay. So they are very capital efficient. Number one, you don't need to put down the full amount. You don't need to put down a deposit to have 100% exposure. Secondly, they're very, very cheap. Now, compared to equities, our cost is only 0.4% plus VAT. So in and out the market, with that, you have to use the shares move up 0.92%. Many shares will do that in one morning. Okay. We just take into consideration with CFDs. If you want to go short, there's additional cost involved. 1.5% of the value, okay, per annum, or minimum of 250 Rand. So if you want to go short, I recommend rather look at single stock futures. Remember, with single stock futures and CFD, both these accounts, you have to go open up and register a separate account. You can't just add a lot to your equity account. There's separate risks involved and things like that. Okay, so if you've got an equity account with us already, obviously we will have your FICA. You might just have to update your the latest utilities bill, but it's very, very easy. You go online and you open up an account online. So you put down 15% to have exposure of 100%, but you're borrowing the other 85%, and that's where the financing comes in. So it's very, very cheap also, very competitive. Roughly about 7%. That's what it will cost you per annum to have exposure. We give up to R1 million exposure to the market without asking for a balance sheet. Okay, so can you see the popularity of these products? Okay. This is what the trading platform looks like. Those of you that are used to the equity platform, it's exactly the same thing. As I say, you'll have to open up a CFD account. You go click, you select your account from the drop-down list, go to new order, and then you go into the trade. You'll see in the top here to say CFD. Okay. So here, for example, we're going to go buy some Anglo shares. I'm going to go buy 100 Anglos at R339.05. That will be my normal exposure with equities. So obviously my exposure is the same with CFDs. I only have to put down 15% margin, however. So I'm putting down 5,000 Rand to have exposure of 33,000. You see what I mean by being capital efficient? I can use my other funds for other positions, other shares. Okay. Second, as I say, the costs. 0.4% of my exposure in this situation, 125 Rand. With that, 154 Rand. Okay, very, very cheap. Compared to equities, it was a normal equity trade, would have cost me at least 305 Rand. Okay, so I want to go long, I want to take advantage of rising prices, I'll go long open up the trade. If I want to sell now, I do the opposite. I'll go back into new order book, go select my Anglos, and I do a short close to close out the position. Okay, very, very simple. That's why CFDs are so popular. They're simple, exactly like you're trading the shares. They're not as complicated as other products as such. Okay, hence the popularity. Single stock futures, very similar. Also derivative, you can also only trade the top 100 companies, go long and short. However, the big difference is now is that single stock futures are regulated by the JSE. They are looking at regulating CFDs, and that will be happening soon. But the main one of the other big differences of single stock futures compared to CFDs, you saw in our previous example, you want to go buy 100 Anglo shares. As long as my exposure is more than 25,000 Rand, you'll be able to get the shares. I can go buy 90 shares as long as the exposure was more than 25,000, no problem. However, with single stock futures, the minimum I can buy is one contract. Now, one contract is equal to a standard quantity of 100 shares. Okay, so that's the minimum I can buy. I can go buy one contract on Old Mutual or one contract on Anglo American. Okay, we'll talk about margin requirements a bit later, and you'll see the example. It's slightly bit different. The JSE decides on those margin requirements. The other big difference is that single stock futures have a life in the sense that they do expire every quarter, being in March, June, September, December. So the third Thursday of these quarters, we are at the moment trading the December contract. So when we get to the third Thursday in March, we'll roll over to the March contract. So you must also take into consideration there's additional cost involved there with a rollover, 0.25% of your exposure. So if you want to keep on holding your position open, it's better to rather roll over because the costs are much lower compared to closing out and opening up a new position. Okay, so take into consideration the costs there. Secondly, obviously, it's still very much the same idea of CFDs. You're putting roughly down 50% deposit to have 100% exposure, so giving you that gearing roughly about 6 times. So again, be aware that these things do come with a wealth warning. That's where the gearing comes in. If you don't know how to handle the gearing, learn more about the product first of all. So risk management is important. So variation margin, adverse price movement. So be aware of that. Okay. Costs again, as I say, very, very cheap, 0.4% per transaction. You also consider that there's a 60 Rand booking fee every time you open up a trade on a particular contract. So if I want to open up a contract on Anglos now and 10 minutes later I want to open up another contract, you only pay that 60 Rand once off per day, per contract, per symbol as such. If I open up Anglos today and I open up another contract tomorrow, I'd be paying 2 separate 60 Rand booking fees. Remember, this is all part of costs. You want to try and minimize your costs. So, nice thing about CFD, single stock futures, there's no scrip lending fee. So, it's obviously much cheaper to go short. Okay. So, the order book looks exactly the same now. The major difference is now that you're buying contracts. So, remember, you can't buy shares, you're buying extra contracts. So in this situation, I'm going to go buy 3 contracts on Old Mutual at 24.60 Rand. That will be my exposure, 7,380 Rand. My margin requirement in this situation is to tell you also 315 Rand per contract. So 3 contracts will cost me 945 Rand. Hence the popularity. A lot of people can afford to trade single stock futures, and that's why they are so popular. As I say, still very cheap. You're talking about 93 Rand total, compared to obviously with equities, obviously much cheaper. So you do it exactly the same way, long open, long close to take advantage of rising prices. A short open, short close to go short. That's how easy it is. Okay. So a quick summary. If I look at the pros and cons, the main thing is it's capital efficient and low trading costs. Okay. Remember with CFDs, there's no expiry dates. So a lot of people will trade single stock futures more on the long side, especially the position traders, the guys that are trend followers. Hold position open for a longer period. There's no expiry date, so there's also no additional cost there. But remember, single stock futures, there is expiry dates. Remember also there's additional cost there with the rollover. The nice thing about single stock futures, you can hedge your equity portfolio. If you anticipate the market to fall, if you've got some sessional shares in your portfolio, the same exposure now on the single stock futures side. What you lose on the equity side, you make up on the single stock futures. And that's where a lot of people are using the instrument to protect themselves. So you also get still all other benefits of capital growth and also all the dividends as such. Okay, that's on the advantages side. The disadvantage, the main thing is that you do not have any voting rights. You can have 1 million Sasol single stock futures, but you do not have the right to go vote at the AGM. Okay, remember it's a derivative product. It is a disadvantage if you don't know how to handle the gearing or understand gearing. So it's very important that we manage risk. So stop loss and position sizing, all that kind of stuff, very, very important. So it is a disadvantage if you don't know how to handle it. So, but you can see that the pros outweigh the cons by far. Okay. That is a quick introduction to derivative products. We'll go into more detail in future webinars. And also you can always drop us emails and any questions you might have. So let's talk about some of the trading ideas that we have been putting out there as such. We've been looking at British American Tobacco, Mr. Price, Aspen Pharmaceuticals, and the retailer Woodies over the last few days. And let's talk about how we got at these trades and why we're looking at these trades and how we actually put the trade on. There's British American Tobacco. We went into this trade at the end of December. We're looking at a long trade. Why did we look at this trade? We're anticipating it's going to bounce off this previous support level. Number one, it is trading very close to our 66% Fibonacci retracement level. Usually the market jumps out of that. But also, what was important for us, it was pretty oversold based on the oscillators, the RSI and stochastic oscillators. So we were using this trend line here as the resistance trend line as a trigger. If it breaks up above it, we were looking at getting into it. So we entered this trade at 428 Rand 50. Our take profit was 460, which was the previous high, and our stop loss was just slightly below that. So that, again, that's why the 200-day moving average is so important. As long as it's trading above the 200-day moving average, it should be more on the long side. But your 200-day moving average also acts like a stop loss. Okay, so that was on the 28th of December. But 2 weeks later, you can see what happened with this trade. The market bounced. We broke out of that resistance trend line, triggered a change in trend, and we were happy to get out and take our 4.5% return on that, or profit on that trade. Now remember, 5% doesn't sound a lot, and but if you look at 5% of your 15% deposit, your margin, your initial margin, you look at nearly a third, okay, of your margin you're putting down, which is not too shabby if you're looking at 30% returns in 2 weeks. Okay, so remember these trades that we put out are for the equity derivative traders, the guys that have active or funded accounts, single stock futures, and CFDs accounts with PSG Online. You'll benefit from this. If you don't get this stockbroker report every day, please send Travis an email. We're glad you put you on the mailing list. Remember, it's a tool to help our clients maybe save time, highlight trading opportunities for you, but also you might use it as a confirmation tool. These are some of the trades you're looking at, and it highlights the opportunities. Okay, so you can see how the market has recovered. We're still going up, so we're happy. We're pretty happy to in that situation with our profits. Mr. Price, we've been talking about Mr. Price for a while, and a lot of people have been talking about the retailers, especially last year. It was the favorite shares be trading. We spoke about Mr. Price a bit earlier. We spoke about the double tops. So hence our trade, our short trade on this share. It was making a double top. It was overbought on our oscillators. So we wanted to enter the trade when it broke through our support trend line. Okay, support will trigger the entry. So we got into the trade at 142.50 with the goal of going right down here to 130. Okay, our stop was at the top. Remember, we short, so you put your stop at the top at the resistance level. If it went up higher, you want to cut your losses and get out. Okay, so that was the reason for putting on the trade. You see what happened. Market broke through that support trend line and fell nicely. We were pretty happy to make our 7% returns on that. Remember, our target price was 130. We did get out a bit earlier because we thought, okay, it's got into oversold territory. It did go a bit further the next day. But, 7%, so nearly 8% of your 15% deposit. We're talking about more than 50%, which is not too shabby. We're talking about, again, a 2-week trade. Okay. This is a trade we are looking at currently. Aspen Pharmaceutical. The reason why we got into this, Aspen has just been added into the top 100 global business challenges, number one. Number two, it's a good company. It's a good growth company. We're looking at a long trade on the share, and we thought, okay, it's starting to turn up now. Came very close to, or bounced off this previous resistance, which would be our support level now. And we just thought, okay, we can get in at 163. With our target price being the previous high, we're talking about risky. By the way, we're putting our stop way down here at 158. We're talking about ultimately our risk-reward ratio of nearly 1.124. I'm willing to risk 4 rand to make 15 rand 70. Okay, 4 rand to make 16 rand. That's what we call a very, very good or high probability trade. Okay, in this situation, we have potential to make 9.6%. of our margin, which is ultimately 64%. So this will get you excited about the trade, and that's why you put it on. So these are some of it, as I say, some of the ideas that we highlight in our stockbroker report. We put out on a daily basis, every day, and also we also put intraday trades out. So if you want to get hold of this report, please send Travis an email, and we're glad to put you on the list. So this is Woolies. We've been talking about Mr. Price. Woolies is very similar. We were looking at this trade, anticipating that a bounce back from these levels, and we thought that, okay, maybe the market was overreacting, and that's why we put out a trade on Woolies. Okay, it was on the 16th of March, that was today. The stockbroker, as I say, it's written by myself and Travers with input from Tian. Gives you our little track record, but basically you can see what's been happening with our trades. We've been doing this trades for about 6 months now. We've done about 63 trades. 39 of those trades were winners and 24 of them were losers. So our win-loss ratio is about 62%, which is not too shabby. Most of the trades are on the long side compared to the short side. And also you can see that the total trades, 213%, our losses are 83% down, but our net position is 103% up. Now, please understand, we don't bring out the stockbroker report to brag about the returns. Remember, this is a tool for our clients to pick up opportunities, just to show that we are on track and we are on the winning side. The trades we do put out are not for the day traders, more for the swing trader to the position traders. You can see the average duration of our trades is roughly about 12 days. And you can see the different sectors that we are involved in. So just to quickly summarize regarding trading as such, professional traders focus on limiting risk. And that should be your main focus also as a small private trader, as such, a small trader. Remember, your number one goal is protect your capital. A lot of the average traders focus on the opposite. They want to see how much money they can make. Okay? from each trade. So professionals will always take money from the amateurs. Remember, the idea is to stay relaxed, set your stop losses, and it's important to watch your stop loss. If you get stopped out, so what? And a lot of our trades, you saw losses there, are stopped out. But who cares? You know, you are just doing your job. The idea is you're still protecting your capital. As long as at the end of the day, we're making more, our winners are more than our losers, and our risk-reward ratio is 1 to 3 or as higher than that, you're making money. You know, you are successful. Now, the challenge of most amateurs as such, you know, we resort to hope and pray. We hope that we're on the right side of the market, and we hope that our trades can go in our direction. You know, if you take the professional approach and you use your support and resistance trend lines as entry and exit points, and you confirm it with your stochastics and RSI indicators, but also you're using risk management like stop loss. You know, if the market goes against you, cut your losses quickly. So it's important to have a trading discipline. And that's, at the end of the day, helps you stay in the game longer, and that's how you're going to be successful in the market. So, in conclusion, just to highlight for you, opportunities coming up. Our next webinar in February, we're going to discuss more fundamentals, and we'll focus on the strategy of what they call value investing. So, our lunchtime webinar on the 20th of February is filling up very fast. We've got 75% full there, and we nearly 65% full on the evening webinar. Our Traders Forum for this year, remember the Traders Forum is more a face-to-face meeting we have around the country. Unfortunately, our Joburg one is already fully booked, and our Cape Town one is filling up very fast. We are at 65% already. So those of you there in Pretoria, we're holding one on the 26th of February at Centurion, at the golf estate there. Please go to our website, www.psgonline.co.za, find the events, and then go book a seat for yourself. Okay, it's from 6 o'clock to 8 o'clock. The idea there is for you guys to meet the traders, but also it's all important for you guys, maybe if you want to meet us beforehand, send through a request, and we can schedule time in the afternoon. We'll come through a bit earlier, meet us at the venue, and we can discuss your any questions you might have. So from our side, good luck and happy trading. Any questions you might have, please send me an email. As I say, my name is Sean van den Berg. There's my email, there's my direct phone number. Any questions you might have regarding this presentation or any of our products. If you have any questions on the trading side, please contact Travis Robson on 996-5204. Alternatively, our office number is 0860-774-774. Thank you very much for your time, and I hope you enjoyed this webinar. Thank you very much. Goodbye.